Hello and welcome back to the Wall Street Petting Zoo. Our This Week at the Zoo news segment. I'm Christopher Carroll Smith,
And I'm Robert Coburn.
and this week was Retail Earnings Week. Happy Retail Earnings Week, Robert.
Woo!
With the Christmas season coming up, it's timely market data on how the retail sector is doing. We started off the week Monday. The market moved a little bit higher despite some pessimistic comments from Chinese officials about the progress of trade talks. The officials said that one of China's biggest concerns about the trade talks is that U.S. President Donald Trump is unwilling to remove tariffs as part of a phase one trade deal, which is kind of ridiculous because a couple weeks ago it was being reported as if we already had a phase one trade deal in which both sides had agreed to remove tariffs.
Yeah, it's almost becoming a boy cries wolf scenario because before the stocks would move fairly big moves based on whatever Trump said and whatever China said, and then now the stock market is trying to hold its ground at least and not make big moves based on what's being said now because it's gone back and forth so many times that we should just keep a running tally to actually count how many times they said, "Oh, we got a deal done," or "Deal's close, deal's close, deal's close."
It is pretty ridiculous at this point, for sure.
Yeah, and then on Tuesday, Microsoft actually released its daily active user numbers for its Team application, which is a competitor to Slack, which is a paid platform. Teams is included with all of Office 365, so the amount of users they reported caused Slack's stock to dip 8%. And I'm sure someone out there has a joke about slacking. And then the Dow also dropped below 28,000 points on Tuesday, which after it's rallied up above 28,000 last week.
Yeah, and on Tuesday we also had earnings misses from retail giants Home Depot and Kohl's. So not a great day for the market on Tuesday. Wednesday, the major indexes fell about half a percentage point after Reuters reported that a phase one trade deal may not get signed in 2019. Another just kind of trade freak out. Those losses, though, were partially offset by strong earnings from Target and Lowe's. Target absolutely took off on Tuesday after it reported really strong earnings and sales.
Yeah, and then on top of the news outlets reporting that the trade deal might not be signed at the end of the year is Charles Schwab and TD Ameritrade on Thursday announced that they may be merging. Well, they didn't announce it, but a rumor from a news report came out saying that they may be merging. So that's $5 trillion in assets if they were to combine. And this caused both Charles Schwab and TD Ameritrade stock to surge.
Yeah, Ameritrade gained 17% on this news. It's they would be a monster. They would be a huge company, a huge giant in the industry if they were to merge. Thursday, we also got a couple other things. We got a housing sales data report came in showing sales are up, inventories are down, and prices are rising in the housing market. Seemed to be fairly bullish news for the housing market. We also got slightly better than expected manufacturing data. So overall, the economy is looking good based on the reports that came out on Thursday. We also had a little bit more trade optimism returning to the market on Thursday because China's vice premier said the U.S. and China were on the doorstep of reaching a phase one trade deal. Seems in some ways like we are just wildly swinging back and forth between optimism and pessimism on the trade front.
Yeah,
And then
definitely.
we also had some retail companies report on Thursday. We had Gap, Ross, and TJ Maxx, which all came in and beat analyst expectations on their earnings reports. But we had Macy's missed on its earnings report and reduced its forecast for the rest of the year.
Yeah, and then on Friday we had more trade talks with Trump again stating the trade deal was close. And there is also concerns that the trade deal may be impacted by a pro-Hong Kong rights bill that is awaiting Trump's signature. I doubt he's going to sign it.
Yeah, that's definitely an interesting question. We also on Friday had a big earnings beat from Nordstrom, pretty significant. And we also had the Chinese president signal that he wants to work with the U.S. to get a trade deal, but that China isn't afraid to fight back against U.S. pressure. So kind of mixed signals from the Chinese side on Friday. But we did get a pretty significant rally on Friday. Let's dig into a couple of these issues a little bit more deeply, Robert. I want to kind of talk about the outlook for trade talks and where we're likely to go from here. A couple of weeks ago, we were talking about a phase one deal as if it was already a done deal, and now no one seems to be able to agree whether we're even close to a phase one deal. We're swinging wildly back and forth. As you mentioned, there's this Hong Kong human rights bill. The House and Senate both passed versions of this week, and the bills require that the U.S. annually review the human rights situation in Hong Kong and impose some sanctions on individual Chinese leaders if China violates Hong Kong's autonomy. And also, Hong Kong has like privileged trade status with the U.S. And so if China were to violate Hong Kong's autonomy, then we would rescind that privileged trade status for Hong Kong. And the bills also give visa protections to Hong Kong protesters fleeing to the United States. And those bills both passed in the House and Senate, and they are now headed to Trump's desk. And he will have to decide whether to potentially antagonize China by signing them. You mentioned you don't think that China or that Trump will sign the deal. You want to say more about that?
To me, well, I'd say from a personal perspective, I don't think he would sign it because it doesn't seem like something he would get behind. But now that you mentioned that he'd use it as leverage against China, I mean, that kind of gives it more credibility of him signing it, because it's one of those things where if it was like a normal day, I don't think he'd sign it. But if he uses it for leverage to gain something out of it, I think he might actually sign it.
Yeah, there's the question in my mind of will he use it as a bargaining chip before he even signs it? Maybe he, will withhold his signature in exchange for some concession from the Chinese side. That's certainly a possibility.
Didn't that just happen in the Ukraine?
Well, yeah. And then, there's also the question of like, how would China really react to it if he did sign it? And I think they would certainly act offended. They would protest the insult, but they wouldn't necessarily actually care about it because the bills don't really have enough teeth to be a deal breaker. The U.S. sort of regularly condemns human rights abuses in China, and China just kind of shrugs this off. So I think that China might use the sort of insult as leverage on their end to say, we demand more concessions from you because you came out and said these things about Hong Kong and passed this bill on Hong Kong. So I think both sides could potentially use this as leverage in negotiations, but I don't expect it to be a deal breaker for anybody.
Yeah, that makes sense.
Also, retail earnings week. Overall, a pretty decent week for retail earnings. Did you look into the Home Depot earnings very closely? I didn't look very closely at that one.
Yeah, so I was so as I reported last week, it was one of the stocks I was looking at, and as expected, basically they met their own expectations. However, they cut their forecast for the second time this year, and the stock tumbled about 20 points. So they went from about 238 to 218. With the U.S. housing market, though, starting to rebound and reaching a 12-year high in permits for future home construction, I'm pretty sure it's a good time to buy in for a long-term play for Home Depot. But in terms of the dip right after they reported earnings, I mean, it usually happens with Home Depot every time they report earnings is it dips and then it goes back up over time. Because if you look at the overall trend for Home Depot, it's up. It's always been up.
Yeah, it's definitely a strong company. I would say overall for the week, the majority of retail companies that reported beat analyst expectations. But one of the things that you have to pay attention to is that analyst expectations were actually really low for this quarter. So for instance, Gap beat expectations, but their same-store sales dropped 4% this quarter. Nordstrom beat expectations, but their same-store sales dropped 2.5% basically. So these companies are still failing. They're just not failing as hard as the analysts were expecting them to fail. So,
yeah,
you got to be careful that you're not misled by reports of a positive earnings surprise.
Yeah, it's like if your parents expect you to get a D and you get a C. I mean, you're still
Right,
you're
exactly.
not doing the best, but I mean, you're beating the parents' expectations. It gets you, you know, chicken dinner.
Yeah. Well, and the companies that missed expectations, not only did they miss this quarter, but it wasn't just a one-time thing. They both slashed their guidance for the next quarter too. Macy's and Kohl's both are failing pretty hard at the moment as well. And even the companies that beat estimates this week, they didn't really raise their guidance for next quarter. They still reported fairly cautious guidance for next quarter. And the ones that beat estimates were the discount stores like Target, Ross, and TJ Maxx, whereas the full price stores were the ones that were missing estimates. So it's great news for discount retailers, but I'm not sure that it's really great news for either retail or the economy.
Yeah.
And then finally, on retail earnings, I thought it was kind of interesting this week. I saw a report from an analyst firm called New Constructs that has this measure of what they call earnings distortion. Basically, on quarterly earnings reports, sometimes a one-time event can make earnings look better than they really are. So the earnings beat won't necessarily carry over to the subsequent quarter. Economists have developed ways of measuring this, and right now the level of earnings distortion in the S&P 500 is really high, meaning that a lot of the earnings beats are because of these one-time line items that aren't necessarily going to carry over. And so earnings are down about 1% this year, but after you adjust for this measure of distortion, they're down more like 6%. And meanwhile, the price of the S&P 500 is up about 24% for the year. So it really seems like the fundamentals aren't really there to support the moves that the market has made this year on earnings. And Richard Bernstein, who's a major institutional investor, is warning that without a trade deal, we may get a full-blown profits recession in 2020 as a result of this earnings distortion. And I would say, I'd point out that's a minority view. Goldman Sachs, Credit Suisse, and Bank of America are all predicting strong earnings and strong market performance in 2020. But this is definitely a risk to be aware of in earnings going forward, that maybe the earnings picture is not as good as it looks.
Yeah, all you pessimists saying that 2020 is going to be the year of the downfall of the stock market.
Overall, I am cautiously optimistic about the economy in 2020, but I do think that it's important to be aware of these risks because there could be a reckoning sometime next year. I do think that indexes are overvalued and that economic data are softer than a lot of the reporting recognizes. And so I'm going to be just hanging out near the exit and kind of closely watching the signs for when I should make a run out the door.
I get the feeling that Trump's going to pull some levers and throw some switches near the election time. So I don't feel that 2020 is going to be the year. Probably 2021, not 2020.
You're probably right. If you look historically at, election years and the year before election years, they tend to be really strong times in the stock market. So just because it's always in the politician's incentive on a presidential election year to make sure that the economy is doing well.
Yeah.
So finally, the housing report. Like I said, on Thursday, we got this housing report that showed sales are up, housing sales are up, prices are also up, new home construction is up, which is why you were saying Home Depot is probably a good long-term buy. Mortgage rates, of course, are down. Housing inventories are also down. This is all great news for the economy and especially for real estate market and the real estate investors. I, by the way, actually own I own the EWRE fund, the Equal Weight Real Estate Fund, and it's been doing fairly well for me last week or two, and I expect it to continue to do well moving forward. But couple things to be aware of in this report. When you dig into the details, it looks like some people may be left behind in this because rents are up 3.2% this year, which means cost of living is increasing without a proportional increase in wages, which probably is part of the reason that discount retailers are doing much better than full price retailers right now. With cost of living going up and wages not going up, you definitely expect to see people cutting their expenses elsewhere. And also, the share of first-time home buyers is down, which suggests that a lot of the buying activity in the market right now may be driven by landlords and speculators rather than by new people entering the housing market. So definitely some risks there.
Yeah, but I think long term wise, because they're saying that a lot of boomers right now are remodeling their homes, and also millennials are starting to buy new houses. So that's why like Lowe's and Home Depot are good stocks to own right now.
Yeah, well, and with interest rates coming down, we're also seeing a ton of new refinancing. So existing debt is getting refinanced at lower interest rates, which reduces some of the risk of people defaulting on debt. Um, Reduces their incentive to, declare bankruptcy in order to wipe out all that debt. So that could be actually a good mitigating factor for some of the risk in the housing market right now. But let's talk about the stocks we watched last week. Why don't you kick us off on this one, Robert?
All right, so I already went over Home Depot, so I'm going to go over Target, which I also said I was looking at this week. So as you mentioned earlier, they blew the expectations out of the water for the quarterly earnings this quarter. They reached new highs, ending the week at 127. Target beat analysts' expectations and also raised its profit outlook for the full year ahead of this holiday season, which is a good sign. Target attributes its survivability by its $2 billion investment they made last year on the digital storefront and also offering same-day delivery a la Amazon. They reported a 31% surge in their digital sales this quarter, so I would advise buying on the dip because right now it's still trending higher. And then the last stock I was looking at is Ross. So they were also report earnings on Thursday. Their earnings report wasn't obviously as strong as Target, but they were strong nonetheless. As expected, their stock dipped after the earnings on Thursday and was down to about 109 on Friday morning. But by the end of Friday, it was already back up to 111.
Yeah, pretty good week. I mean, your Target pick was fantastic pick. Target actually just went on a total tear after the earnings.
Yeah.
All day it just ran, ran, ran.
What about the stocks you were watching?
Well, I had if you remember, Snap was on my list. I actually had a really great week. In fact, almost everything on my watch list this week did really well. Snap started the week already too high, so I actually wasn't even able to get in the morning on Snap because it had already gone on the run that I expected it to go on. It ended the week up 9.5%. So I'm sorry that I missed out on that big run, but sometimes that's just how it goes. Nectar Therapeutics is another one that I was watching. I'm up. That one's up more than 7%. So it was a great week for me in Nectar Therapeutics. Unfortunately, I've got a fairly large position in that one. Overall, I'm up like 16% on that one, so I'm feeling pretty good. Disney ended the week up 2.5%. CVS is up 1.5% this week, and Walmart was up about 0.5%. The only one that didn't go well for me was JD.com, which is down almost 5% in the last week. And I actually am buying more of that on this dip because its earnings the previous week were really good, and it's gotten a lot of analyst upgrades in the last week. So in my opinion, this is just a technical pullback before the stock moves higher because it had moved pretty high ahead of earnings. So it came down a little bit after earnings just to correct for how sort of far and fast it had moved. But I think that it will move higher. And so it's currently about $32 per share, and most of the analyst price targets are up in like the 43 range. So I think we'll probably see $40 per share in JD.com sometime in the next year. So I'm looking for about 25% upside from the current price over the next year.
What does JD.com do again?
It's an online retail stock.
Okay.
How about the stocks that you were watching this week, Robert?
All right. So this week, there's actually a lot of big companies that are actually releasing earnings on this short week. Keep in mind the stock market is closed on Thursday. It is open on Friday, but probably at reduced hours. I think they have an early close on Friday. But the stocks I'm looking at this week is Palo Alto Networks. So with cybersecurity being a very hot field in my field, the IT industry right now, it's no big surprise that Palo Alto Networks, a networking company with strong ties to cybersecurity, is doing really well. The stock is up 40% from the start of the year. During this last quarter, it was reported that Palo Alto Networks beat out Zscaler out of a high-value deal, and while it is gaining from its previous acquisition of Redlock, it also recently acquired Zingbox, which may impact their quarterly reports this quarter. Also, HP, which is in the middle of a hostile takeover by Xerox, which is funny because I think Xerox's stock is cheaper than HP's right now. But you may benefit from the stock if Xerox does buy out HP. The stock is relatively cheap, but a little inflated on the news that Xerox is starting to get aggressive in their attempts to buy out HP. I think Xerox came out and said they're going to aggressively go after buying out HP. I think they were targeting like $22 a share, and right now their shares are only at $17 a share. So I'm going to be on the lookout for that. Dell and VMware, they're actually two separate companies, but they're pretty much tied at the hip. Not only does Dell own a majority stake in VMware, but they both report quarterly earnings this week. So Dell provides not only hardware in the form of laptops, desktops, and monitors for the everyday workforce, but Dell also runs Blade servers. And what runs on those servers? VMware runs on those servers. However, with more companies moving from on-premise infrastructure to the cloud, Amazon's AWS and Microsoft's Azure, this is a space that may not prove to be valuable long-term. And then Dollar Tree, the place where everything is a dollar except their stock. This didn't make sense to me at first glance at how much their stock is worth, but after reading into the details, it actually makes sense that Dollar Tree and Dollar General have this high of a stock price. Dollar Tree reports earnings this week and is expected to beat expectations and is similar to Lowe's in terms of overall trending upward, but with a lot of peaks and valleys in between. So it's a good short-term stock to use as well.
I listened to a fairly interesting podcast about dollar stores and grocery stores and how dollar stores are putting grocery stores out of business because dollar stores focus almost exclusively on manufactured products with really high profit margins, whereas grocery stores have to stock a lot of higher quality kinds of nutrition that the profit margins aren't as good. So the dollar stores move in and they make a lot of money, and then the grocery stores aren't able to make money on the products that they traditionally had made money on, like those manufactured processed foods and so forth, because everybody's going to the dollar stores for those. So anyway, kind of interesting. I don't love dollar stores if they're putting grocery stores out of business, but it does seem to be a good business model. So, and then it's kind of interesting to watch HP and Xerox. I agree with you. Takeovers are always great for a stock bump, but it's kind of like watching dinosaurs eat each other.
Yeah, that's a good analogy for that one.
This week I am watching JD.com, as I already mentioned, and then I'm watching two others. Nokia is down something like 40% since its last earnings report, but I think the drop is not entirely justified. So I've been watching for like the right moment to enter that, and I think that we are there now. It's got a bunch of positive news recently. And it finally, watching the chart and everything, I see divergences and stuff that tell me that it is ready to start making a steady recovery. So I think that Nokia will probably do well for the rest of the year here. And I also think that we'll see some signs of life from Qualcomm this week. If you remember, Qualcomm popped really high on its earnings report, but then it's been pulling back ever since. And it has now pulled back to its pre-earnings level. So this is the level at which I expect it to now start moving back up higher. So probably this week I would expect maybe anywhere from 2 to 5% of movement in Qualcomm.
Yeah, Nokia. I bought it before the quarterly earnings report.
Oh no!
So I'm like, I need to double down now to make my money back. So I'll probably look into buying more this week. So that way,
it's time. Yeah. It's time.
And then Qualcomm, I'm surprised they actually dropped back down to their pre-earnings level.
Well, it happens sometimes when you get a really, really strong move on an earnings report. Sometimes you'll see a pullback, but also just like trade pessimism. Semiconductors are really exposed to China, and Qualcomm's earnings coincided with like really strong optimism about we thought we had a phase one deal in hand. And so then when it became clear that we didn't have a phase one deal in hand, Qualcomm has been moving lower, I think, on that news. But it should, now that it's back where it was pre-earnings, it should start moving higher again, just because, this is where people are going to have their buy orders set as a result of this being the pre-earnings level. So I think we'll definitely see a move higher this week. All right. Well, thank you so much for listening to our podcast this week. Love to see you here this week at the zoo, and hope to see you again next week. If you love the podcast and find this useful, please give us a like, share, or comment on YouTube. Share us on Facebook. You can like our Facebook or Twitter page. If you're listening on YouTube, you can find the links for that underneath the video. And also, we have a referral link for Webull, that if you don't have a Webull account, you can follow the referral link to Webull and open an account, deposit $100. You get a free stock. We get a free stock. It helps support the podcast, and it's great for you too. And what am I forgetting, Robert?
Happy Thanksgiving.
Happy Thanksgiving. Thanks so much.